As 2018 draws to a close, what should we expect from the global economy next year? My next guest says critical political and geopolitical events will create choppy waters for investors and policymakers alike. Guy Miller is the Chief Market Strategist and Head of Macroeconomics at Zurich Insurance. Guy, thanks for coming in. Let's start with the broad macro picture. Global growth below the long-term average next year.
Yes, I mean, remember, it's coming from a level that was above the historic kind of averages, and we think that 2019 will mark a continued slowdown of that. So not a dreadful outcome, but one that certainly is a lower growth trajectory than we had seen in 2018.
And what about US growth? We've been talking a lot about the fact that the yield curve in the US has inverted, at least in part, and that is seen as a precursor to a recession. Are you concerned about a slowdown? In
all my years, I've never seen the fixation on this small inversion that we're seeing now, so I think it's something that everybody is focused on. I think there is a slowdown, and I think that is coming for a number of reasons. One is that we're going to have, by the end of the year, 9 rate hikes by the Fed, the shrinking of their balance sheet by $50 billion, so there's tightening taking place. And also, this is an economy that's been running beyond full capacity, so it shouldn't really be a great surprise that growth will slow over the course of 2019.
So you mentioned the Fed there. Obviously, in your notes, you actually mentioned that the US monetary policy is going to be one of the defining issues of 2019. So what are you expecting from the Fed?
Well, I think what the Fed does matters for the rest of the world, and our view would be that they probably do a little bit more tightening in 2019, but we suggest actually a pause should occur, because when you think about the impact that we've seen, we still have to see how that manifests itself. We're seeing the interest rate sensitive parts of the economy slow quite noticeably, in the housing market in particular. So we are seeing signs that the tighter rates are having an impact, and inflation, which only just kissed their target earlier in the summer, has now fallen back again. So the Fed have got time, we think, on their hands to wait and see how things are panning out, and if they need to raise rates later in 2019, they can of course always do that.
Now, another key theme for the US this year has been the trade war with China.
Yes.
Do you see that continuing into 2019? Is that going to be another key theme for the next year?
I think it is. I mean, I think the pause that we've seen on this and for the 90 days will come back. I think ultimately there will be some kind of resolve. I think that's kind of a consensus view in this one, because I do think both sides realize it hurts them. China is seeing weaker growth than they would like, and the US are also seeing that it will impact the consumer side. It increases the price that consumers have to pay. So it's in both interests at some point to find resolve to this, but I'm not quite sure that it's going to be in the next few weeks.
So what's your growth outlook for China going into next year?
Well, China, I think, is critical, and I think the policy initiatives that they've implemented over the last 12 months or so have almost been too successful. They have been tackling shadow banking, they have been tackling the excess credit that's out there, and that's led to growth, I think, coming in slower than they had intended. And as a result of that, we think that there's going to be additional stimulus. We've already seen some tax cuts effective in October. There'll be more that come through in the 1st of January. Incentives in terms of the car producers as well to make cars obsolete and have an incentive to buy new ones. So ultimately, we think that 2019 will show stabilization really in the first and second quarters of the year, and that should be encouraging for global investors.
So will that help to lift Chinese equity markets as well?
I think so. I mean, Chinese equities, it's been a bear market. You forget how difficult it's been for the Chinese equity market so far. So I think valuations are looking attractive, and I think once you see that stabilization, I think investors will be lured back towards emerging markets more broadly, and I think China specifically.
So what's your outlook for emerging markets more broadly going into next year?
Well, the two things that we've just mentioned, I think, are going to define that outlook. If the Fed does back off and pause, that of course will maybe take some of the upward pressure off the dollar, clearly critical for a lot of these emerging markets that have had to keep pace with the Fed in terms of tightening. And secondly, I think once you get signs of stabilization in the Chinese market, I think all the countries around China, the export markets, the tech plays around that, I think will benefit, and that will, I think, improve sentiment towards emerging markets more generally.
So do you think the US dollar's peaked?
I think it's in the process of doing so. It's always a dangerous call when you think about the dollar, and of course the Fed can change that outlook. But I think given the appreciation that we've seen, and given what we think about the likelihood of many more rate hikes coming through, it seems to me it's an overowned trade, the dollar. It's been a one that you've seen money gravitating towards, and of course in the more volatile times too. So I think that's kind of overowned, and I think the downside is more likely from here.
Now, switching focus to an issue closer to home, of course, Brexit has been front and centre this year, well, ever since 2016, really. I mean, how difficult has it been to do your job making predictions, and will next year bring more clarity, and will that help to restore investor confidence in the UK?
Well, you think it almost must be more clarity, given our starting point.
It can't be any less.
It can't be any less. And from the difficulty and the challenges, I mean, I think it's something that we've had to just kind of park for some time, because knowing exactly how this manifests itself is almost impossible. It changes, as you implied, by the day. You know, going forward, I think a lot of that kind of has been priced in. However, you see what's happened to sterling. There could well be further downside if it's a hard Brexit, but I do think that a lot of that is already in there. If you think about the UK equity market, I mean, the dividend yield's attractive, the type of companies on it are attractive, it's an unloved market. And at some point, I think once you get any kind of clarity coming through, I think it has some potential to lift from current levels.
So do you think this is a good time to get into the UK?
Still too early. I think you have got time on your side. I think you can wait and see how things play out. Because it's been so unloved, I think that when people start to come back to it, it will take time to really bottom out, to create a base and then to move higher. And I think if you see that happening, then I think you have got time to then to put a toe back in the water and enter the UK.
Now, I want to get your take on the European economy. We've had some patchy data ahead of the year that the ECB is expected to normalise policy. We've also got Mr. Draghi's retirement coming up. So it's a busy year for the European monetary policy in particular. What's your outlook for European growth, and what will that mean for the central bank?
Well, I think European growth has been somewhat artificially depressed in the last part of 2018. And I think when you get into the first part of 2019, you'll get some kind of rebound there. Part of it was related to the auto sector in Germany. And I think one of the things that's more encouraging is that you've seen France, you've seen Germany, you've seen Italy now provide additional fiscal stimulus. So that's going to be something else that kicks in the first half of 2019. So growth, I think, will be a bit of above trend. It's not going to be stellar, but it will be, I think, fairly decent. And I think given where expectations are now, there's a little bit of a surprise in the upside, but we shouldn't get too carried away by that.
And what about succession plans for Mr. Draghi?
Critical. I mean, I think of all the issues that we've mentioned up until now, I think one that's often overlooked is the Draghi situation. I mean, I think he's been resolute. He's got that steely determination to do, as he said, whatever it takes, and the market certainly believed in that. So his replacement will be critical. I think also how the market is faring at that time. You need somebody who's got that kind of gravitas that will pull investors with us. So I think that's going to be a big issue as we get into the autumn period of 2019.
And finally, where are the investment opportunities next year?
I still think it's probably in equity markets. I said that because 2018 has been rather disappointing, to say the least. But if you look at the fundamentals, the economy is still decent. Earnings growth will slow appreciably, but again, that's largely been priced in. Multiples have compressed. Money has exited equity markets. And I still think the one that is most vulnerable is credit, corporate credit, I think, globally. Still over-levered, still interest coverage very low. And it's still a late-stage cycle where equity holders are generally favoured over debt holders. So I think that's something to bear in mind.
And would you suggest a kind of diversified regionally? Are there any sectors in particular that you think are attractive?
I think diversification is always the standard mantra for investing, and I think particularly in a year that is going to be as choppy as we think it's going to be, I think that makes sense. But I think you have to be nimble. I think it's not one of these kind of buy and hold for the very long term stories in 2019. I think when you have got market moves, when you can capture and lock in some profits, I think you should do so because I don't think it's going to be smooth. Volatility will remain, I think, high through the course of 2019.
Guy, thank you so much for your time.
Thank you.
That was Guy Miller, Chief Market Strategist and Head of Macroeconomics at Zurich Insurance. I'm Victoria Scholar. Thanks for watching IG and have a happy new year.